Coming up in today's show, S&P 500 hits all-time highs, consumer sentiment surges higher, is it time to sell tech stocks, the Fed pushes back on rate cuts, and shares of Spirit surge higher after appealing a judge's ruling. Hey, what's up guys? Welcome back to the Click Capital Daily Market Show. Hope you're all doing well out there. And if you didn't know it already, we are officially in a bull market, and that is because the S&P 500 just broke out to a fresh all-time high today, above 48.18, which the index reached in January 2022. Also got the Nasdaq hitting all-time highs, up almost 2% today. That was thanks to the likes of NVIDIA surging higher again, reaching almost $600 a share, up over 4%, along with AMD up over 7%, and the leading sector today, semiconductors, up 3.8%. This is the strongest sector in the stock market right now. And just looking at today's heat map, it's obvious how much semis are outperforming there in the bright green, but a lot of strength across the whole tech space, included as financials bouncing back pretty good, along with industrials. We actually saw a bit of a rotation out of the defensive names, healthcare and utilities, as this market is feeling really good here. And since today was the third Friday of the month, that's regular monthly options expiry date, OPEX, and it was a big one, 52.6 million contracts traded, 58% of them calls. And once again, people loading into calls on the Magnificent 7. We can see that in the really low put percentages in NVIDIA 41, Tesla 40, Meta 36, Microsoft 27, Apple 29, Amazon 33%. And there's a look at the year-to-date heat map. You can see that huge outperformance straight out of the gate from NVIDIA, up 20% for the year. AMD not too far behind, 18%. Apple still flat on the year, and we've got some bump ups in Microsoft, Google. The weakest of the bunch is Tesla, actually down 14% for the year. And the rest of the market's pretty much mixed, a little bit soft, especially energy names so far this year. And so the most important piece of economic data we got today was the Michigan Consumer Sentiment Survey, coming in a lot higher than expected, posting its largest 2-month gain since 1991. Americans are feeling really good about the economy. We've got the stock market hitting all-time highs, inflation's coming down, gas is low. And so there's a look at a one-year chart of the Consumer Sentiment Survey, coming in at 78.8 today, well above expectations of 70, and that's a clear breakout over the last year. Taking you out to a 3-year chart, you can see consumers' feelings on the economy bottomed in July 2022. We've turned up since then. However, just taking you out to a 5-year chart, consumers still not feeling as good as early mid-2021 after the economy and markets recovered after the COVID pandemic, and still not back to those peaks before the pandemic in late 2019. Everyone was feeling really good about everything back then, but nonetheless, it's back into an uptrend and we are turning up here, and you can see that's the biggest beat on expectations in years. Not only that, we've got chip stocks reaching for the sky here. That was after we saw strong earnings from the biggest contract chip maker in the world, Taiwan Semiconductor, coming in a bit better than expected and forecasting a return to growth this year. TSM traded up again today, up over 1%, and this market is convinced we have entered a new paradigm on the Magnificent 7. Not even aliens landing on Earth are going to knock over these big tech stocks. A lot of people saying they should continue to outperform the bottom 493 stocks in the S&P. That's because collectively, the group is expected to grow earnings by 46% in the fourth quarter compared to the rest of the S&P, who's collectively expecting an earnings decline of 7%. So they are doing all the heavy lifting of this market. The AI boom is real. Companies are spending big on GPU chips. And we saw that reinforced today with one of the world's top 10 richest men, Mark Zuckerberg, saying Meta will own billions worth of NVIDIA H100 GPUs by year end. That's 350,000 GPUs. With Mark going on to say our long-term vision is to build general intelligence, open source it responsibly, and make it widely available so everyone can benefit. We're building massive compute infrastructure to support our future roadmap, and so those big companies just can't get enough of NVIDIA's GPUs. And you got to hand it to Jensen Huang, CEO of NVIDIA. He saw this coming years ago. That's why he invested heavily in the infrastructure to lead the way. Now it's estimated NVIDIA hold over 70% market share for AI chips. We've also got one of the leading tech stocks from the last couple of years surging again today, Supermicro Computer, up over 35% after the server and computer products maker boosted its financial guidance for sales and earnings, with the company citing a strong market and end customer demand for their rack scale AI and total IT solutions. And just look at that rip in the stock, surging on 23 million shares, and that too just hit a new all-time high. So tech led by semiconductors is ripping as strong as ever before. Some people may be wondering, is now the time to sell? Well, historically speaking, very hard to time the tops. It's human nature to kind of want to call a top when things are reaching up high. However, I for one definitely wouldn't short these names here. It's very hard to get in front of this hot momentum. Valuations by a lot of measures are stretched. However, valuations are more long-term mean reverting than short-term. In the short term, momentum, liquidity, and sentiment rule supreme. So if I was long tech stocks here, I would just keep my trailing stop and ride it up for as high and as crazy as it wants to go. Like we've been saying on Click Capital for a few months now, stocks could continue rallying pretty hard into the first Fed rate cut. We'll also be watching for some seasonality patterns to play out this month. What happens at the start of the year can have a big impact on the rest of the year. We've got a failed Santa Claus rally. We've got a failed first 5 days. Next thing we'll be looking at is the January barometer to see if the month can finish positive, because if all 3 of those things fail, sometimes it can lead to soft results more than average. So far for January, we've got the S&P up 1.47%, the Nasdaq up 2.8%. However, the broader market is still a little soft. We've got the Russell 2000 still down over 4% for the month of January. So still a bit of work to do underneath the hood to get some really bullish breadth happening across the board here. But we could be following some seasonality of election years. And since 1950, when the year before an election year was up over 10%, stock market on average finished up 10.5%. We typically rise into mid-February, then we'll come off into mid-March, and then it's pretty much straight up to the right for the rest of the year. And last year, the market followed seasonality to the T, and generally election years are strong. Incumbent government doesn't want to see a recession or a stock market crash. They're going to do everything in their power to prevent that from happening. However, there's just one little problem that could upset the whole narrative, and that's probably the most robust and reliable macro indicator that's out there, and that's the yield curve. And so looking back in history, when we get a yield curve inversion, that's when long-dated bond yields go below short-dated bond yields as they forecast upcoming economic weakness. Looking back in history, there's never been a post-inversion equity market rally that has not been more than fully reversed going into a subsequent downturn or bear market. So here we are in the red line, and we're probably around here now. And this is the biggest rally since we've had a bond yield curve inversion. However, looking back in history, it's been nothing but down. As pretty much every single time we've got a yield curve inversion, the market will go into recession afterwards. And so what you're looking at here is a long-term line chart of the 10-year yield minus the 2-year yield. That's the yield curve. And so when we go below zero, that's the yield curve getting inverted. Like I said, when long-term bond yields go below short-term bond yields. And that's the bond market, which is the best at pricing the future, seeing upcoming weakness in the economy. And if I just overlay this chart with the unemployment rate, and we'll just zoom in a little bit, typically the bond yield curve will go in inverted, then uninverted before the unemployment rate. So it's kind of a leading indicator, and you can see that correlation between the yield curve and the unemployment rate. And we'll just overlay this chart again with US recessions here shaded in the gray. And like we can see, when the yield curve goes from inverted to uninverted, pretty much every single time a recession follows it. And so here we are now. We've got the yield curve climbing back to uninverted territory, getting pretty close there. Yet the unemployment rate's still really low, hasn't caught up yet. So just looking back in history, like I said, the yield curve's a leading indicator. And if this yield curve keeps climbing above zero and the unemployment stays low, that truly would be a this time it's different scenario in the market. Also, another pattern looking back in history at the unemployment rate, still historically really low here at 3.7%, is it's kind of the opposite of the stock market. You know, the stock market has been known to take the stairs up and the elevator down, while the unemployment rate is the opposite. It takes the stairs down and the elevator up. Looking back in all past cycles, unemployment rate trickles lower and lower and lower, then all of a sudden, boom, it spikes out of nowhere. And we can see that every time. So when the unemployment rate does rise, it rises sharply and quickly and pretty much catches everybody off guard every single time. So we already know the yield curve's rising. The next big indicator for a pending recession will be this unemployment rate, the labor market. But like we've just seen, consumer sentiment's really high. Retail sales are better than expected. Gas is low. Tech stocks ripping up to all-time highs. Everyone's feeling good at the moment. But just like all previous times, it's hard to forecast what will actually knock the market over. Previously, we had global pandemic, global financial crisis, tech bubble bursting. Who knows what it could be next? But either way, it'd be truly remarkable if the unemployment rate manages to stay below 4% this entire year, because we start getting above 4 and a 4.5, it's almost guaranteed we're going into a recession. And I know that's crazy to talk about when no one's really thinking about that now, when the S&P's trading at all-time highs, but it's something to keep in the back of our mind, just looking back at past historical patterns. And so everybody's been getting excited that the Fed's going to cut rates soon, because it's pretty much a given that apparently inflation's going back down to 2%, it's going to stay there. But if you listen to the Fed members themselves, they keep pushing back and saying it's too soon to think about cutting rates. We saw that from Chicago Fed Chief Goolsbee. Also, the San Francisco Fed Chief said the same thing. Premature to think about cutting rates now. And so bond traders are currently repricing the chance that we do see a rate cut in March. We've seen a bit of a bump up in treasury yields and a big repricing this last week in Fed fund futures. But over a week ago, they were saying almost 80% chance they're going to cut in March. Now it's about 50-50. Not only that, we've got inflation expectations coming back up. You can see here in the spread of inflation, protected treasuries versus regular treasuries, back into a short-term uptrend. And this is at a time when we don't even have oil moving higher, still a bit muted here. Trading sideways, it's holding above $73 a barrel. Biden administration is really trying to keep the supply up, want to keep the price of gas down going into the election. However, Iran and the Saudis, they want to see it higher. And so you can expect more flare-ups from Iran-backed militant groups going into the federal election. They're going to try and knock the US markets and government. They really want to see that price of crude higher. But for now, oil traders aren't really worried about what's happening. Over our shipping and cargo ships being attacked in the Red Sea. The Western Alliance, led by the States, is firing back on Houthi rebels in Yemen, but is doing it in a measured and proportionate response, so as to not try and start a major regional conflict, which could really get the price of crude bubbling then. Moving on to crypto, we've got the Grayscale CEO saying most of the 11 approved Bitcoin ETFs won't survive. Now, they're kind of like the original Bitcoin trust that's been around for years, and they were fighting the SEC for years, trying to get approved, going back and forth, and it was finally when Wall Street's biggest asset managers got approved, they got approved as well. And so they still have a huge 1.5% annual management fee on their Bitcoin trust compared to most of the new Bitcoin ETFs that have fees between 0.2 and 0.4%, and they're still the biggest trust. Something like $24 billion in assets under management versus BlackRock's iShares Bitcoin Trust, which just passed $1 billion. And they're trying to defend that fee by saying they're the largest Bitcoin fund. They have a 10-year track record and a diversified investor base. They'll probably be forced to lower it to come closer in line with the industry, but they know so many people have been in there for years and they don't want to realize capital gains tax, so they're just better off paying that huge fee and staying in there. Also on crypto, the biggest crypto exchange in the States, Coinbase, still facing a lawsuit from the SEC, accusing it of selling unregistered securities. However, Coinbase is trying to make the case that cryptos isn't a security, it isn't an asset, it isn't a currency. Rather, it's more like collecting Beanie Babies. Just like JP Morgan CEO Jamie Dimon says, he equates Bitcoin to like having a pet rock. With Coinbase lawyers saying that when a cryptocurrency is bought, the buyer doesn't gain any rights like they do when they buy stocks or bonds. And the SEC pushing back, saying that unlike Beanie Babies, when a crypto token is purchased, the owner is invested in the network or enterprise behind the token. And so even though the SEC's approved these Bitcoin ETFs, they're still coming after the exchanges that facilitate their buying and trading, saying that they're dealing in securities and they have to adhere to the same regulations as anyone else dealing in securities. So the industry is still a bit of a mess, still not really clear where regulators stand on it. And ever since those new Bitcoin ETFs have launched on the market, we've seen Coinbase pull back a bit here, even though the new Bitcoin ETFs come out of the gate pretty soft as well. And so like I've been saying, I'm looking at the spread of the new Bitcoin ETF from BlackRock versus Coinbase, as I think for most investors it makes more sense just to buy the Bitcoin ETF and have BlackRock as your custodian versus pay a much larger fee and have Coinbase on the other side of your trade. Either way, it's an interesting story to cover. Got Bitcoin still holding just above 41,000. Definitely could pump again, but I don't know. I'm not so sure it'll be easy for all these new ETF Bitcoin holders. It's quite a big consensus in the crypto community that we're going to 100,000 this year. And some say even beyond that $1 million a coin is inevitable as well. We'll just have to see about all that. Anyone else getting a little bit of deja vu? Coming back to the bubbly days of late 2021. Even so much so, we've got Reddit, which was at the center of the meme stock craze back then. It's looking to IPO in March, going from a private company to a public company, and they may have just nailed the timing with tech stocks breaking out to new all-time highs. Should be a successful raise. They were last valued at $10 billion. In their 2021 funding round. Even though the company remains unprofitable, they were looking at ad revenue last year at $800 million. And so who knows, maybe we see a resurgence in some of these little meme stocks on the back of the Reddit IPO. But they have a long way to go, just looking at a monthly chart of Robinhood. I remember they came onto the market mid-21. Meme stock buyers jumped on it like crazy. They did a secondary offering up here, absolutely created the stock, gone from $85 a share, and here we are today, 2.5 years later. still down here just trading above $10 a share. And look at AMC, what a sad story that is. Now getting down to almost a penny stock, and the poster child for them all, not doing that much better either. GameStop still well down off its highs. And congrats to those who bought the dip on Spirit Airlines yesterday. Saw it rip huge today after the carrier actually raised its guidance. Still keen on getting a deal done. And just as I speak, news has hit the wires that they're going to appeal the ruling from the judge. A lot of people in the industry saying the judge made a mistake, and that's lawyers like Lionel Hutz saying the judge grossly mischaracterized the burden here that stated the harm to a single consumer is substantial, basically saying it's not good for competition. But I mean, Spirit Airlines is now less than $1 billion company. It's hard to imagine they could be squashing consumer competition in the airline industry in an economy as large as the States by that much. And there's a look at the daily chart of Spirit Airlines, climbing over 17% in the regular trading session. And on the back of that news that they're going to appeal the judge's decision, we're up over 8% in after hours as I speak. Moving on to economic data we got today. Retail sales year over year. United Kingdom coming in a lot weaker than expected. Still really soft economies across the pond. Doing a bit better in North America. Canadian retail sales coming in better than expected, up 1.8% year over year. There's the Michigan Consumer Sentiment Survey, blowing past expectations, and still got a soft housing market, but that doesn't seem to really matter too much these days. If anything, it is of benefit to the home builders. Should come as no surprise, we've got the Fear and Greed Index climbing again today, getting to the top end of the greed zone, market breaking out to all-time highs. Looks like we're bound to go into the extreme greed zone next week, and we have been elevated up here for a couple of months now. But corporate insiders aren't really as keen as much as the call option buyers out there, showing some of their lowest levels of buying. Only 42 purchases yesterday, still doing a decent amount of selling here. 187 corporate insiders selling their own stock yesterday. Looking at Brett today, we've got a bit of a bounce back. Still less than half of all S&P stocks above their 20-day average. Like I said, most stocks are a lot softer compared to mega cap tech. Looking at liquid stocks and ETFs that hit 52-week highs today, we've got 440, mostly filled up by tech and semis. However, what you also see here is the yearly performance column. A lot of these stocks already up over 20, 40, 50, 100% in the last year, just continuing to move higher. On the other hand, just looking at stocks and ETFs breaking out of 52-week lows, coming in at 145 today, it's pretty much vice versa. Stocks that had already been doing really bad over the last year, down 20, 30, 50, 70%, getting weaker. A lot of the names showing up here from China. And so it's a case in the market of what's been strong is getting stronger and what's been weak getting weaker. And so Chinese stocks are probably the most hated asset in the market right now, and mega cap tech is probably the most concentrated trade that I've ever seen as well. Classic VIX Friday crush, no surprise there, coming off more than 5% down to low 13s. Same with volatility, risk premium, put call ratio really low, everyone loading back into calls. Still have to pay a little bit for your tail risk insurance though. Got the 2-year yield bumping back up, with the 10-year almost reaching 420 today. TLT making new lows again. High yield bonds continuing to trade better. Dollar pulled back slightly. Still got gold trying to hold above these $2,000 an ounce level. Huge reversal in the natty gas market. Going into that cold snap in the States, it ripped up and it's given it all back. International stock indices had a mostly positive finish for the week. Nikkei breaking out again. And we may have found a bottom on the Chinese stock market. Got some big volume coming in here, along with these technically oversold signals. Developed international stocks still diving relative to American stocks. Like I said, strongest stock sector today, semiconductors just ripping up there, along with broad tech, and even saw a good bounce in regional banks going into their reporting season. Still got some weakness in the clean energy sector. Solar stocks coming off again. Airline stocks coming down, and a little bit soft in the defensive sectors as the market is rotating back into growth. My 2024 picks had a good day, led by cannabis ETF. We've already covered the Magnificent 7. Got Tesla. Still trying to find some support down here. We're looking for it to hold this gap, 205, 210. Let's not forget we got earnings next week on Tesla. That'll be a big one. Got a continued bounce back in Boeing. And there's Alibaba putting in quite a decent bullish engulfing candle here on big volume and below $70 a share. I think it's a good contrarian play, good long-term value. This thing's trading on a free cash flow yield north of 20%. And just looking at those vulnerable regional banks, doing pretty good here on Friday. And the big guys perking back up as well, with JP Morgan continuing to hold on to its 50-day. Right, there we are, guys. Another interesting week in the market. We were getting soft underneath the hood to start the week off, and looking at my sector trends table indicator, we still have a bit of softness in some sectors out there, especially utilities, oil and gas, energy, clean energy, the gold miners, and a little bit in REIT and biotech. The real standouts continue to be home builders, semiconductors, anything to do with tech, financials, industrials still doing well, and of course the big indices all above their moving averages. And just switching on my market risk on off indicator, we're still in a risk on mode here. Switching on my trend candles, the market's still in a bull trend, especially the Nasdaq, even the Dow Jones, and even the Russell 2000. They're still in a technical uptrend. Some good volume coming back into the Russell here on Friday, even though it's the weakest index of them all. But regardless of the macro backdrop, still a strong possibility of a recession this year. Just looking at the yield curve, definitely would go against the consensus. First and foremost, we follow the technicals. Price first, fundamentals second. Hard to argue with all-time highs. That is bullish, and it's very hard to step in front of that strong momentum. However, we'll be keeping an eye on those macros and fundamentals. But like I said, mega cap tech just driving this market, leading this market, and it seems they are invincible and nothing can knock them over until something catches us all by surprise. That's all I got for you this week. Thanks very much for tuning into the Click Capital Daily Market Show. Appreciate all you guys that hit the like button and drop a comment. I reply to everyone, so please let me know what your thoughts are on this market, how much higher we could go, whether you think we're going to get a recession. I'm always interested to hear other people's opinions. Other than that, have a relaxing weekend, and I'll see you all again next week. Cheers.